Hello, everybody. Kind request to the people who are live here, present physically in the Hilton, to come back for the next speaker. And hello to our online viewers. We've listened. We took quite a deep dive into CBDCs for the first part of this morning. And we've heard central bankers and innovators speaking about that. I'm absolutely delighted to introduce to you the next speaker, Nicolas Kozakiewicz, who's Chief Innovation Officer with Worldline. I'll only say a few words about Worldline, and then I'll pass the floor to Nicolas. Usually when you speak about blockchain and cryptocurrencies, there are a lot of names that the people who are familiar with the traditional banking and finance system, are not, they don't resonate a lot with those names. Why? Because they are the new kids on the block. Many of them don't have a long history and so on. I find particularly relevant that the next speaker is coming from Worldline. Worldline is a global payments leader, and they started their operations, if I may say, 3 years after I was born. So it's in 1973. Okay, so there's a company which is global and has a lot of history in dealing with payments, huge reputation. Therefore, I find it even more interesting to hear what is their view on what Nicolas called as the title of his panel, Digital Currency Transformation. Nicolas, do we have you online?
No, I'm here.
Oh, okay, please, sorry. I was, for whatever reason, convinced that you are going to join us online. So,
no, I'm here.
It's even better.
Okay, nice to meet you.
Nice to meet you. Just pick a seat and...
Well, actually, since I have a presentation, if I may be standing, that's even better. Okay. So thank you very much. So first, I would like to say online and of course in the room and even outside, if there are people from central banks, please bear with us because I'll be talking concretely about CBDCs. If there are people from commercial banks, please stay because I'm going to talk about things we can do for commercial banks. And for people who are in the crypto world, I'll be also explaining a lot about what crypto is and how we can leverage it as a technology. So lots of interesting things. So I will try to add up to what's been said so far. And one thing that really struck me that Anthony said is that it's about education. And that's true. That's true. Actually, I am a lecturer on blockchain in many prominent engineering schools and also business schools, including HEC or University of Columbia in New York. And what is important is really to understand what the technology is about if you really want to get the most of the technology. So we'll try to take a little let's say, zoom on that, not a technological one, a really, really concrete feature one. Because what is important here is to see what can we do with that technology. So I happen to not come from the financial world. Actually, I'm an engineer by trade, and I worked many years in telco, and then I joined only the payment world quite recently, 10 years ago. But what is interesting is that from my standpoint, I see financial world with a different angle as people who are only within finance to start with. And that's why I tried to make some sort of link between what happened in the technological world and what is currently happening in the payment world. Hence, the digital currency transformation. So we all heard about the digital transformation. So when I talk about digital currency transformation, let's see what was at the origin the digital transformation. First, here, you can see that everything is, it's not that easy to use. Everything is about infrastructure. So when we talk about a service is an infrastructure. If you take the mail service, regular mail service, you need to have envelopes, stamps, mailboxes, mailmen, trucks, sorting services, and again mailmen, again mailboxes, just to convey some information. That's a full infrastructure. That means that you have a very high barrier at entry. If you want to become a postal provider, you need to come up with all this. Same thing for payment. If you take the card example, to be a payment provider with cards, you need to issue cards, you need to have terminals in the field, you need to have banks, you need to have processors. So it's very complicated. Again, the barrier at entry is super high. Same thing with telco. all these have very high infrastructures, so very high barrier to entry, which is a protection. That means that if someone wants to disrupt your business, you have to come up with all of this. Then came the digital transformation. What is the digital transformation? Actually, it's internet. And the digital transformation is taking all of these services onto one infrastructure, internet. Because internet does lots of things. You can shop on it, you can go do social things, you can have phone calls on it, you can watch movies on it, you could do so many things that were before in discrete infrastructures. This is what the digital transformation is. So as you can see, it evolved a lot because technologies do evolve a lot. It started off like this, and this is now what all know what it's like. And what we've seen with that is that lots of things happened, evolutions, disruptions. Let's take an example, telco. Telco were hit very hard by the digital transformation because they had a business model change. You remember those days when you had your phone, you wanted to phone someone, say, "What is your operator?" "Oh, no, I cannot call you. It will cost me a fortune." Because you used to pay by the minute. Do you care about this anymore? You just phone in Japan or on the other end of the world. So because here, everything has been commoditized. Now you pay for a subscription fee, not a usage, subscription fee. And telco had to adapt. Let's talk about transport. I mean, even the name became a verb, Uberize. They changed everything. Retailers, Amazon. Now you go into a shop, you check the product, and you order it on Amazon because it's cheaper, because you have a better guarantee, whatever. They totally changed the way these businesses are run. Hospitality, Airbnb, or even media with Netflix. And what is important here to really understand is that all these people, when it started, they said it is unfair competition because it was a lack of regulation. Why did telco have to accept MVNO? Why did they have to accept over IP? Why did transporter had to accept Uber? Why all these people had to accept them? Because there was a hole in regulation. And regulation is like the cavalry. They arrive after the battle, but they try to solve what initiated the battle. So we all need regulation. That's no question. But something is important. Here, all these people used internet as a way to carry information. But these people, payment people, were not touched by digital transformation. Why? Because they need trust, not only data exchange. And trust is not provided by internet. Internet just carries information, hopefully not corrupted. But that internet is best effort, no trust. So payment was okay until one day, until October 23rd, 2008, where Bitcoin appeared. And what Bitcoin showed is that it was possible to have trust on top of internet. You have to see Bitcoin as being an additional layer on top of internet that provides trust. The good old Web3, that's only that. And thanks to that, now you can have lots of contradictory usages like payment, traceability, ownership, identity. All these were not possible without a trusted third party before. Now it becomes possible natively. And you had all these new words, cryptos, ICOs, DeFi, NFTs, great words, ways to make fortune in no time. This was better than heaven. And just one reminder for bankers in the audience is that when Libra started, lots of people from the banking industry said, it is unfair. And when you say it's unfair, that means that you are getting Uberized. So you have to be very careful. So just a little look at what happened since 2008. I just put some dates here. Original white paper in 2008. On the left-hand side, that was payment only. Then after that, you have more than payment with the first ICO and lots of things, NFT, DeFi. I didn't put everything, because as you know, there are so many examples. But I just wanted to underline some things, because we all have the impression that this is the start of everything, but actually it's also sometimes the end of some things. Look at this. Mt. Gox, created, disbanded. Or ICOs. I mean, first was Mastercoin. Do you still hear a lot of ICOs these days? No. It was super trendy 2 years ago, 3 years ago, but now I think it's just out of fashion. NFTs, that is super fashionable. Well, actually, it started off in 2010 with colored coins with a simple Bitcoin transaction. So it's not that new, but it's super fashionable, and DeFi and everything. So we can speak about this because we've been working since 2018 in production with blockchain services. And I underline 10 times the in production, because doing a pilot is one thing. Running it in an industrial environment is another thing. Just like telco, if you want to speak with someone, 2 yogurt pots and a string works. If you want to have worldwide coverage, yogurt pots and strings do not work anymore. And if you take a look at what happened last year, it was incredible. Look at all those countries' names. Look at all those big names. Tesla, MasterCard, Visa, PayPal, Stripe, Novi, which is actually the wallet of Facebook, WhatsApp. All these guys, suddenly, they all jumped on the bandwagon. Why is that? Why is that sudden rush? I mean, it started off in 2008. That's an interesting question. And by the way, we kept on providing new services still at industrial grade. So just to give you a bit of more information, let's take just 3 slides on what is the blockchain so that we're just online. When I present the blockchain, I say it's like a box. The box has a slot, a keyhole, and some sort of output. Let's call it a printer, but not any printer. A printer with super paper, with threaded metal in it, something you cannot copy easily. And the blockchain is a notary system. You insert some information. If you have the right keyhole, the right key, then it's going to output some certified information. It's going to stamp the information. And if someone comes in with other information and the right key, then it will append the information. So it's a way here to make sure that your information are notarized, certified, that they cannot be changed. This happened in the past. No one can change that. So, of course, I represent here a physical box, but we are in the digital world. And what is the greatest power of digital? Control-C, Control-V. In the digital world, you can make exact copies of things. In the physical world, you cannot make exact copies. You have to make copies, but not exact copies. But here you can make exact copies. So let's leverage this, and let's make copies of that output in lots of places. And let's put them behind bars. So that means that should someone be able to modify this information, they would have to break an entry in all the other places to change the history. And that's the power of blockchain. The power of blockchain is a one single point of truth because it's immutable and there are copies of it everywhere. So that's the greatest strength of blockchain. The important words that we use are the following. The ledger. The ledger is the output. It can take many forms, blocks, acyclic graphs, you name it, but it's just a log of information. There's the user access, that's the slot. So there are 2 types of blockchain, and that's super important. There's the permissioned and permissionless. Permissionless blockchains are like boxes outside in the street. Anybody can put some paper in. You don't have to register, you don't have to be known. Anybody can put information in it. And you have the permissioned blockchain, where only trusted, certified, chosen people can use it. Just like when you are voting, it's a permissioned environment. Only person who are registered can vote. Then you have the processing. And here, each time I hear somebody say decentralized, I go like, no, it's not decentralized. Blockchains are highly centralized. They are distributed, and by the way, DLT doesn't say decentralized. It says distributed, not decentralized. So it's distributed, it's parallel processing, you call it whatever you want, but not really decentralized. So here you have two main ways of operating a blockchain. There's the public and private blockchain, and that is super important. So of course, public and private does not mean state-owned or not state-owned. It would be too easy. A public blockchain means publicly operated blockchain. So in other words, let's imagine I'm building a wall. I'm on the side of the street, there's lots of rocks, and I'm building my wall. In a publicly operated blockchain, anybody who walks past can say, I'm going to help you. And I cannot refrain that people from helping me. I cannot say, no, don't help me. That person will help me no matter what. I don't know if that person knows how to build a wall. I don't know if that person wants to build a very high wall or a very thick wall. I don't know. But I have to work with them. And then you have the privately operated blockchain where I choose who is working with me. So these are very important differences. And of course, there's the business logic. What happens between the moment you put information in and you have information out. And then it can be, well, nothing. Information gets in, it's stamped, it gets out. Or there can be scripts. The information gets in, you check that the form is properly filled, okay, stamp and out. Or the smart contracts, which are non-smart and that are not contract either. It's just dumb programs. That's just pieces of code that will check, okay, is that date later than this date? Okay. Are the form properly filled? Okay. And then it's going to stamp. There's no magic to it. It's pretty simple stuff, but it can be useful. So this is everything you need to know about a blockchain. Now, let's take a concrete example with Bitcoin. In that environment, what is Bitcoin? So when I present a blockchain, I usually present a plane, like a table. Around that plane, you have the users represented here by those pyramids. In the Bitcoin use case, the blockchain is public, so anybody can operate, and is permissionless. Anybody can use it. So here the pyramids are pseudo-anonymous people. You have John Doe at gmail.com, you have Bob123, classical people. And here on the right-hand side, you have the blockchain that is for the moment empty. Since Bitcoin is a blockchain with a cryptocurrency, because all blockchains do not have a cryptocurrency, you can have it or not. This one has one. That means that there are tokens. And these tokens can slide on the plane, but they cannot fall off the plane, and you cannot add any more tokens. People tend to think that in the Bitcoin you add tokens. That's not true. You have a certain amount of predefined tokens, just like at the Monopoly game. At the Monopoly game, at the beginning, you have the bank that has everything, and each time you make a full round of the plateau, you get 40K. Well, the Bitcoin is roughly the same thing. Each time you mine, you get a bit of the money. When there's no money left, well, you won't get any more money. And all the Bitcoin blockchain does is the following. If a token moves from a pyramid to another one, the blockchain will write down in an immutable way, so no one can change the fact that right now, this token moved from this pyramid to that pyramid, and that's over. It's written in stone. If it moves again, the blockchain will write down that then, because there's a chronological order, it moved from that pyramid to that pyramid, and so on, and so forth. So as you can see, it's just a list or movement of a token between pseudo-anonymous peers. So why Bitcoin or public permissionless blockchains are so unstable? It's like this. Imagine at the very beginning, you have here the Bitcoin blockchain, and you have here this guy that's going to be help processing. He's going to mine. And as a reward, he gets some money from the Bitcoin bank, just like at Monopoly. But the token doesn't worth anything for the moment. And then you have this guy. We are in a permissionless environment, so we don't know who the guy is. He comes in with $1. He says, hey, I would like to buy a token. Hey, cool, let's do that. The token gets a value, $1. Then you have another guy that comes in with $2 saying, hey, can I trade your Bitcoin? The guy says, yeah, I'm doubling my value in no time. I mean, this is better than casino. Yeah, let's do that. And now Bitcoin is worth $2. It was worth 0 just before, just pure speculation. Then you have this guy who has $3 dirty, but we don't know that yet already. And he's going to trade those $3 for a Bitcoin. And the other guy is happy. He made plus 50%. Woo! And then at the bottom right, you have the family man with $3 hard-earned dollars. He wants to save money for his kids, for university. And he looks at it and says, oh, why do I work? I mean, there's easy money to be done. I'm going to buy a Bitcoin. So he's going to go and ask the guy, can you trade it for $3? And the guy says, sure, I mean, it's your lucky day. Let's do the trade. What did we just witness? Money laundering. The guy had $3 dirty dollars. He had $3 clean dollars, no traces. And then suddenly people know that it was dirty dollars, the value drops, and the family man will be happy to sell his Bitcoin for $1, and he lost $2. And it's going to go over and over and over again. So with the same technology, if you make it private and permissioned, then you have a whole different story to tell. But the same technology. I mean, Mr. Bucher said it clearly. We have to switch. We have to decouple the use cases and the technology. The technology is good if you use it right. If you go in a private environment and that you KYC everybody, and that you say, now it's not people who want that process, it's people I pay to process. So there's no reward. They are paid with a contract, not a smart contract, with a contract, a legal contract. And let's imagine that we are having tokens, but these tokens, they actually represent something. Here we have in the vault 4 bars of 1 gram of gold, all with a serial number, and each and every of my tokens bear the same serial number. It's attached one-to-one. It's pegged one-to-one. This is one case of stablecoin. It could be fiat currency, could be commercial currency, could be stock market, whatever. It can be anything. As long as you peg it, it has the value of the object that is pegged. Then, if you have someone coming in, first, he has to do the KYC. And if he wants to purchase a token, it's not him saying, I'm going to buy it 1, 10, or 100. He buys it the value of gold, because there's a market for that. So there's no speculation. It's just a tool, a trading tool. And if someone comes in, even though that person go through the KYC, if a person offers $3 for something that's worth 1, that's going to be suspect. So the person will never come here. That's why they're going to be in the crypto asset world and not in the stablecoin world. So I hope that with that, it's clearer. So as we said, in the digital transformation, we can see that now it's possible for lots of actors to become also payment providers. And we all read in the news that PayPal, Amazon, Facebook, and Google, Facebook, Apple, and Amazon are working on it. They want to become payment providers. But why? If we take a look at I'm French, so I'm going to take the euro standpoint, but it works in each and every central bank environment. But in euro, you have the European Central Bank, and at the table here at the top of the European Central Bank, you have all the national central banks that are sitting. Banque de France, Bundesbank, Bank of Lithuania, all these banks are sitting there. Then, one level below, at the table of each national central bank, sits all the commercial banks of the region. And then, at the table of each commercial bank of a region, sits us, users. Here, there are actually 2 types of money. And that's why when we say CBDC, it means something strong. It means central bank. And central bank is not anything. Central bank money is central bank money. So central bank money is the money used between central banks, commercial banks. The only tiny part of central banks we see as end user is cash today. And then there's commercial bank currencies. Each and every commercial bank issue their own money. And they all have different monies. when you make a SEPA payment, a check payment, or a card payment, you actually pay in commercial money. So when we talk about wholesale, wholesale means banking world and financial world. This is done 100% with central money. There's just happy few, not that many users. Low volumes compared to retail payment, but very big amounts per transaction. And when we talk about retail, that's the rest of us. 100 million of users in Europe, lots of transactions, but smaller amounts per transactions. And here, roughly, we have 1/8 of our payments that are done in cash, hence in central money, and 7/8, that's huge, are done actually in commercial money, in money from the commercial banks, not in central money. So what we see is that thanks to the blockchain technology, now alternate money provider can come in. Facebook said, I'm already connecting to you, and to lots of merchants. Why do we need to go through banks? I can do it. I mean, we were speakers here were talking about M-Pesa. I mean, telco operators did it before. I mean, and they say we don't need. I mean, there's no banks, but we can do the same thing as bank. We can provide payment means, and that's true. So the risk is lots of new alternate money providers will come, or actually are coming. And these are not small companies. These are big companies. These are not companies with little money means. They have big pockets. And these companies are very good with the technology. So we have to be aware of that. So to me, CBDC that we see everywhere is a sign from central banks to other banks, hey, wake up. Something is happening. We need to all go digital with very efficient means. And digital euro is not there to replace cash. It's there to complete cash. Of course, it will eat a bit of cash, but it will also take a little bit of the ground that was taken by the commercial banks. And we need to find a solution there. We need to find a solution for commercial money. So, to us, what is one of the biggest problems we have to solve? Is that when we talk about payments, like check payments, well, the problem, it's not a payment, I'm sorry to tell you. It's an IOU, it's a debt, because the payee's bank has to ask the payer's bank to pay it. But since banks don't want to be paid in commercial money, they only want to be paid in central money, you have to clear and settle in central money each and every transaction, which makes it slow, super expensive, so 20th century. Account to account, same thing. It's an account from an account. It's not a payment. It's an IOU. Again, each and every IBAN or peer-to-peer whatever has to be cleared and settled. Slow, not efficient, super 20th century. The card, it's even worse. You have to issue a card. You have to have a terminal somewhere to make a payment? No, to make a debt. That has to be cleared in the scheme environment, then cleared and settled in the payment industry. So here it's super expensive, super slow, really 20th century. When you look at cash, cash is a real payment. When I hand out a note to someone, the clearing and settlement is done immediately because it's central money and it's accepted everywhere. Actually, it has to be accepted. It's legal tender. Now, if I ask you, and of course it can be reused immediately. Now, if I ask you, what about Bitcoin? Is Bitcoin payment or IOU? Oh, I mean, I underlined it. So it's a real payment, because when you receive a payment, a Bitcoin, okay, it takes 1 hour still, but there you have the real value, and you can reuse it immediately. So if we decouple the use case Bitcoin and the technology, then all the people say, hey, you know what? I'm going to use the same technology, blockchain, and I'm going to make my payment a real payment. So that's why the higher barrier to entry that we had as payment providers just dropped, so that anybody and their brother can issue their own alternate payment. Why do you think that there's like 2,000 different coins in the crypto world? Because it's so easy. I mean, anybody 12-year-old, I mean, when I'm giving lessons, I show them how to create a currency in 20 minutes. It doesn't take more than 20 minutes. That's how low the barrier is. So that's why we have to beware there. If you take a look from another standpoint, payment today goes from bank account to bank account. So of course there are other means like American Express or cash, but at the end of the day, everything goes back to the bank. So that's why the bank today, commercial bank, is so important, because all points back to the bank. But the problem is that crypto arrived. So at the beginning it was no such big deal, because everybody was turning them into fiat currency at the end, so that was okay. But now, people, they keep their cryptocurrencies. But to have a cryptocurrency, you need to buy it. So you need to take some deposits that you have at the bank to put it in the crypto world. So all the money was in the bank, and the banks were able to make loans, commercial banks. And now we have less and less deposits, because deposits starts to be scattered across. But it's getting even worse, because now with all the stable coins, we have more and more places to put our money, away from the bank's deposits. So that's why what we say is that there are opportunities, and the opportunities are managing this. We have to manage the complexity for bearers. On stage here it was said, what do I do if I have 10 different wallets? Well, you take one super wallet. And for merchants, if they have to accept lots of different rails of payment, then you provide them one acceptance payment. And then, once you have solved the complexity of number of rails, then you can create all the rails you want for future usage, like a real fully private rail, or like a full central bank rail, like a CBDC. You can create all the rails you want, or rails with a specific insurance in it. You can create all the rails you want. So if we take the example of what we can do, for instance, with a blockchain technology that we have at industry grade, is, for instance, the use case of CBDC. So it is a fully private blockchain, permission, so all the peers here are totally known. And the ECB would create some euro tokens, just like the ECB is printing banknotes. When a national central bank requests some cash today, you need to have a guy in arms and a truck. Here, you just push the tokens on the blockchain. When a commercial bank needs some cash today, again, the truck with a guy in arms. Here, you push it on the blockchain. When I need some cash, I need to find an ATM. I just request it, and my bank pushes the token into my wallet. And when I pay, I just push it to the merchant. And the merchant reuse it immediately, because it is central money, just like cash. And eventually, it will go back to a commercial bank, not the same one, and it will go back to the European Central Bank. So this is how CBDCs can leverage the blockchain technology. And of course, if we can do it for central bank digital currency, we want to do it for commercial banks that we call multi-bank digital currency, which is the same principle, but here it is issued by several banks, not the central bank. Central bank issues central money, commercial bank issues commercial money. But the principle is the same. The banks would just load that up on the blockchain, no trucks, no guy in arms. I don't need to go to the ATM anymore. I can pay anybody I want, and these persons can reuse it immediately, thanks to the blockchain. And that's what blockchains are for, allow this kind of setups. So of course, it's easier said than done, because the real complexity is in the industrial part. When we talk about Europe, we talk about hundreds of millions of users, trillions of transactions. We talk about one main central zone, so the peaks will be happening at the same time, and we need a high level of security. So we are the #1 provider in Europe, so we know what it means to really manage this kind of complexity. But of course, piloting is one thing, going industrial is another thing, but we are leveraging the fact that we are for more than 45 years in business. We work with more than 320 financial institutions. We have more than 126 million cards that we have issued. And we're managing tens of billions of transactions. So again, the complexity is in the operation, but the blockchain, we tested it for many years now. Well, tested it. We have it in production for years now, and we can confirm that it's a very safe and solid technology. Any questions? Thank you to my fan club. Yes.
Just
Yeah.
a second. Here's your mic.
Thank you. So, when you talk of central bank digital currency backed by blockchain,
Not backed, but operated on the blockchain.
On
Yeah.
the blockchain. Do you see it as a limited supply from the beginning, or a variable supply, I guess? Or a variable supply?
Again, this is a regulation, and it's a question for central banks. Central banks usually issue a certain amount of euro, then later on either it removes some euros of the market or it put back some euros in the market. But this is the financial policy of the central banks. So I leave that to central banks. I mean, on these technologies, we can issue more, we can remove, we can do whatever we want. So that technology is really at the service of central banks.
Thank you.
There's another question here. If there are questions online as well, you're most welcome.
One reason why people like cash is privacy. And in your system, you do AML in the beginning.
Yeah,
And most
KYC.
probably, you also supervise money laundering.
Yeah.
So how do you solve this goal conflict between privacy and supervision?
So we have ways, actually. One of the very simple way here is, for instance, when we issue wallets, then we issue a bulk of wallet for a bank. So Bank A has, let's say, 2 million wallets. And it's up to Bank A to provide it to Mr. A or Mrs. B. So the central platform sees wallet number, but does not know who is behind that. And the same way around, banks see wallet, but don't know where it comes from or where it doesn't go from. So we have all the privacy and all the shielding ways to make it transparent for some, but also private for some. And no one but maybe in the ECB case, maybe the central bank can have a full picture if they want. But if they don't want, we could also say that you may not have the full picture. But again, let's put it this way. Like I always say, the only real privacy is like putting a raincoat, a fake beard, sunglasses, taking some cash from one ATM, going to one shop, making some change, going to another shop, making some more change, making to a third shop, make more change, and then spend your money. Roughly, when you take a banknote from the ATM, usually the average number of bounds is 1.1. So there's 1.1 transaction before it goes back to a bank. So today, banks know exactly where you spend your cash because it was given to you and it was given back by the first merchant to whom you gave the money to. So privacy is important, of course. There are ways to manage it, but it's not the real privacy as we could expect it is not that true. Even at Bitcoin, I mean, in Bitcoin, everything is visible. So if you really want to nail people, you can. It's very complex, but you can. Other questions? Or I'm in the way to the break. I can understand that.
I think you're exactly there, Nicolas.
Exactly. Well, thank you very much. And if you have further questions anyway.
So thank you very much, Nicolas, for the detailed and very interesting presentation. And we are now...